Hey, what's going on YouTube, and welcome back to Tech Conversations. I am your host Guillermo. It is April 5th. Let me know in the comment section below how you guys are doing today. As you can see, it is a green day for me, up $760 today, or about 0.87% so far. And the last week we are up almost $5,000. So we'll see what the rest of the day brings us. But in today's video, I want to talk about a very powerful and cheap strategy that we can implement in a non-volatile environment to potentially make 300, 400% returns. So we'll talk about how the strategy works and what type of stocks you want to be using for this strategy. So before I get into that, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. Check out the Discord, link to it in the description below. Over 17,000 members, completely free. But you can also become a premium member around here for $7 a month. You'll get access to a bunch of great resources. One of them is our alerts. Here's an example of an alert from today. This was a call option on Apple. We paid $167. We closed out at $259. So we made a $92 profit per contract on this alert. So again, if you're interested in joining the Discord, link to it in the description below. Now let's get right into this video. Let me know in the comment section below if any of you guys like using this strategy and with which stocks. So the goal with this strategy is that we are looking for stocks with low volatility. In other words, little to no price movement, a stock that usually trades sideways. And so I want to use WFC Wells Fargo. If we take a look at Wells Fargo in the last month, hasn't really moved much. It's kind of stayed between this defined range. It's kind of been trading sideways, right? I mean, the low has been, 38.15. High has been a little bit higher than 41. For the most part in the last week, it's kind of stayed within a $1 range. So these are the type of stocks you want to use with this strategy. I'm not telling you to use Wells Fargo, but this is the one I'm going to use for the demo. So let's take a look here. So remember, make sure you've enabled your options on Robinhood. Once you've done that, you can go over to the options here. And the way this is going to work is that this strategy will consist of 4 different call options of the same or with the same expiration date. And so the way we can think of this is as an in the money bull call spread or debit spread and an out of the money bear call spread or credit spread. And so let's take a look here. So first, what we want to do is we want to kind of determine what price do we think Wells Fargo will be on expiration date. So our expiration date that we've chosen is April 9th. I always like to use the closest expiration dates to me because that way we don't have to worry about longer periods of time, and the price can change a lot more over longer periods of time. So I like to use the shortest expiration date to me, which is April 9th here. So what price do we think Wells Fargo will be on April 9th? Let's say I think on April 9th it will be pretty much at around the price it's at right now. So then what we're going to do is we're going to sell 2 calls here. And we want the share price to be between the strikes of these 2 calls. The price that we think the stock will be at expiration, we want that to be between these 2 calls. So if we think it's going to be around this price, we're going to sell a call at the 40 strike here and at the 39.50 strike here, right? And again, the reason we're choosing these 2 strikes is because we think that on expiration date, the price will be between 39.50 and 40. So for selling this call, I'm going to receive 33 cents per share. Or remember, each one of these contracts controls 100 shares. I'm going to receive $33. For this one, I'm going to receive 53 cents per share or $53 per contract. So now I'm going to receive about $86 for selling these 2 calls. But again, this is consisting of 4 call contracts. So now we need to buy 2 calls. The first call will be a strike price higher than both of the calls that we sold. And what we want to do here is kind of come up with a price that we think Wells Fargo will not be above by expiration date. So I'm going to choose the 40.50 strike here because I don't think that on April 9th, Wells Fargo will be above 40.50. So I'm going to buy this call. It's going to cost me 21 cents per share, $21 per contract. And then finally, I'm going to choose one that's below, a strike price below the 2 calls that we sold. So I'm going to choose the 39 strike because I don't think that on expiration, Wells Fargo will be under 39. And so I'm going to buy this one. It's going to cost me 83 cents per share, $83 for the contract. So as you can see now, we go here further and we only want 1 contract. This is only going to cost us $15. And by the way, this is called the long call Condor spread. So you can see it's relatively cheap, $14. If you want to figure out what your max potential profit is, you can do that very quickly. you just look at the strikes of the two calls that you sold, you subtract them from each other. So 40 minus 39.50 gives us 50, and then we subtract how much we're paying. So 50 minus 15 is $35. That's going to be our max potential gain here. And we'll take a look at that here now that we're going over to the options profit calculator so that we can take a closer look at this. So again, I always like to use the options profit calculator to visually see what our max potential profit or loss will be depending on what the price of the stock is, depending on what date it is. So what I'm going to do here is I'm going to go over to custom and I'm going to go to 4 legs here. So now that we're here, we can enter the symbol of the stock. So we're using Wells Fargo. And as you can see, currently at $39.56. So we're just going to construct the exact same trade that we had on Robinhood here. So I'm just going to go ahead and do that quickly. So we're going to buy, remember we're going to buy a call. These are all calls and they're all on the left. Make sure your expiration date is correct up here. We chose April 9th. So we're going to start off with the 40.50 strike call that we're buying. Now let's go ahead and write or sell. We're going to sell the 40 strike call. So again, calls are on the left, correct expiration date. So our 40 strike call is right here. Then we're going to go ahead and sell or write our 39.50 call. So make sure expiration date is correct. Calls are on the left. 39.50 is right there. And finally, we're going to buy our call. Make sure expiration date is correct. Calls are on the left. And this was the 39 strike call. Right. So again, we're paying 20, then we're receiving 34, we're receiving 55, and then we're paying $84. For the range here, I'm going to go 38 to 41, and then I'm going to calculate this. So let's take a look at how this looks like. So let's first focus on this these numbers up here. So entry cost $15 net debit, right? So to enter this trade, it's going to cost us $15. We're going to have to pay $15. Our maximum risk is also going to be $15, and we'll take a look at where that happens. Now, like I mentioned, our max return, you can find that by taking the strikes of the two calls that you sold, you subtract them from each other. So 40 minus 39.50, that's 50. And then you subtract how much you paid, that's 35. That's our max potential return here. And again, we'll take a look at where that happens. And then it also gives us our break evens at expiration. So let's focus on expiration date for now. So if on expiration, the price of Wells Fargo is at 40.35 or 39.15, you're breaking even. You didn't make any money, but you didn't lose any money. If it's between 40.35 and 39.15, you're going to make some money. Now, in order to make your max potential money here, which is $35, the price of Wells Fargo needs to be between these two strikes. That's why we chose these two strikes, right? Because remember, the first thing you need to ask yourself here is, what price do I think this stock will be at on expiration date? And then you want to sell your calls around that. So if it's between $39.50 and $40 on expiration, we're going to make our max profit of $35. And we can kind of see that here, right? $39.50 all the way to $40, we're making $35. If it slips under $39.50, we still make some money, not as much. Same thing if it goes above 40, we still make some money, but not much. Until we hit 40.35 up here, we break even. If it's above 40.35, we're going to lose a little bit of money until it hits our strike up here, 40.50. So if it hits 40.50 or above, right here, above, we're losing our max potential loss here, which is $15. Similarly, if we go down and it hits our call right here that we bought, 39 strike, if it hits that or goes under, we're again losing our max potential loss here, which is $15. So as you can see, there is kind of a wider range here where we can make our max potential profit. And as you can see, right, we want this to kind of stay within this predefined range. That's why you want to find a stock with low volatility, stock that trades sideways. Now, the other thing, of course, is, this kind of looks very similar to the iron butterfly, which we talked about a few days ago. I actually have the iron butterfly here. It is a little bit different. There's a lot of differences here. For example, on expiration date with an iron butterfly, it has to be within a more defined range, right? Your break evens here are 39.92, 39.08. So there's less than, it's about an 80 cent range that this needs to be in for you to make a profit. If you take a look over here at the break evens, there's about $1.20 range that this needs to be between so you can make a profit. So with this one, there's a higher probability that you can make a profit. However, your max return isn't going to be as much as it is for the Wells Fargo one, or I mean with the Iron Butterfly one. The other thing, of course, is assignment risk, right? So that's something that you always want to be careful with. Assignment risk, that happens a lot with these types of, strategies that involve multiple contracts. I shouldn't say it happens a lot. It is rare, but it does occur, and it's definitely something that you should check out. So one thing to note is, how would we close this out? So remember, if you want to close any trade out, all you need to do is do the exact opposite trade. So if I buy a call and I want to close out of that call, I would sell the call, same expiration, same strike price, right? So if you wanted to close out of this trade, which I would always recommend doing, don't let them expire, is instead of, for example, buying a call at the 39 strike expiring on April 9th, I would sell a call on expiring April 9th at the 39 strike call. Instead of selling this 39.50 call expiring on April 9th, I would buy a call expiring on April 9th at 39.50. So you basically just switch these buys into sells and the sells into buys. You do that as one whole transaction. That's what you would do to exit this trade. That's how any trade works, right? You want to do the opposite trade. So again, so like over here, instead of selling this call expiring on the April 9th at the 40 strike, I would buy a call expiring on April 9th at the 40 strike. So that's how you exit these types of trades, guys. And again, I would definitely recommend doing that. Don't let them expire because, again, there is assignment risk with these types of trades. So anyways, that's kind of all I had to talk about. If you have any questions, feel free to leave them in the comment section below. Check out the Discord, link to it in the description below. I hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.